Hello everyone. In this video, we will be going over the periodic inventory, multi-step income statement, and closing entries. This is using a the balances of the accounts to prepare an income statement and then the journal for our closing entries under the perpetual inventory system and answering a few basic questions about what is the inventory system being used and what the net income would be if the other inventory system is used. So this is going to be very valuable for the format of what the question is looking for and learning about the specific closing entries involved with the periodic inventory system. For more information on the specific journal entries involved, please watch my chapter Chapter 5, Part 2 lecture on the periodic inventory system journal entries. Now for our first question, does Weinman Company use a periodic inventory system or a perpetual inventory system? Which account listed would not be listed under both inventory systems? We click on our first questions box. They're using a periodic inventory method. This problem is on the periodic inventory system, but we know that it is periodic because we have purchases, purchase returns and allowances, purchase discounts, freight in. Under the perpetual inventory system, we would only have cost of goods sold. And under the accounts listed, the only one on here is purchases that would not be under the perpetual system will include merchandise, delivery, customer refunds payable, as will the periodic. However, the periodic only records cost of goods sold as an adjusting entry at the end, and purchases is one of the amounts involved in that. Now to start building our income statement. We pull up our account labels and descriptions. We need to have the income statement is for the year ended December 31st, 2025. And the label for the first, what's the first item in the income statement? It's going to be sales. So we look through our balances and we find sales of 3,280,000. Now for our account, label for the next portion, we're going to have our cost of goods sold section, and then we're going to calculate our inventory available for sale, cost of goods before estimated returns, and then eventually our cost of goods sold in total. And the inventory as of the beginning of the year is our starting inventory balance. And we need this because the periodic inventory system, we take the beginning inventory, we add in all of the purchases to get our inventory available for sale, and then we take account of our inventory at the end of the year, and the difference is our cost of goods sold. So now we have to calculate our cost of merchandise purchased. And the accounts related to cost of merchandise purchased. And hold on here while I rearrange this a little bit. We're going to start with purchases. And that is 2,650,000. Then we need to add in our purchase returns and allowances. And our purchases discounts. And our freight in. This is all the costs and discounts and allowances related to purchasing our inventory that we sold during the year. And as you can see, the negative 37,000, because purchase discounts reduce our cost of inventory. However, it's not accepting a negative value. Therefore, we just have to put in 37,000. However, when you're adding all this up, you have to make sure that your purchases are in addition to goods available for sale. And we'll put in that amount description right now just to make it a better visual for ourselves here. But the total cost of merchandise purchased is what we're trying to calculate and display here on the income statement. And our purchase returns and allowances were $93,000. This also reduces our goods available for sale. So if we take our purchases of 2,650,000, we deduct our purchase returns and allowances, our purchase discounts of 37,000, and then we have to add our freight in cost of 48,000 because that's an additional cost to getting this inventory. As you can see here, the total cost of merchandise purchased is 2,568,000. The next item we have to calculate is the total inventory available for sale during the year. And that's going to be the inventory at the beginning of the year, which we have to add in, the January 1st inventory balance of 257,000 plus the total cost of merchandise purchased for a total of $2,825,000. That's our inventory available for sale. Now, our inventory as of December 31st, during our count, we only counted, let's see in the instructions here. The inventory as of December 31st, 2025 was $305,000. And so that's what we're going to put. And then from that, we get the cost of goods sold before estimated returns. And that is the inventory available for sale minus the inventory as of the end of the year because that was unsold. And then we get a total of $2,520,000. Then we subtract the um, right, this is the before estimated returns. We have to um, find out what the change in estimated returns was during the year. As of the beginning of the year, estimated returns inventory was $35,000. As of the end of the year, it increases to $40,000. That net increase of $5,000 to our inventory reduces our cost of goods sold because this inventory is estimated to be returned to us, which means that we didn't accrue the revenue for it. We backed out the revenue. We have to back out the cost of goods sold, as you remember from our estimated returns journal entries. Therefore, we have to reduce it by $5,000. Increase in estimated returns inventory is a line item for us. And then we have our ending cost of goods sold, $2,515,000. Now, after cost of goods sold, we can subtract our sales minus our cost of goods sold, and we get what's called gross profit. And our gross profit after that calculation is $765,000. Next comes our operating expenses, starting with our sales expenses. And we can get that right off of our labels here, operating expenses, starting with selling expenses. And we're going to list our expenses in order. And selling expenses come first because that's the largest amount of our expenses. If we look on the chart of account, on the account balances description here, our largest expense is sales salaries expense. And as well as advertising expense, delivery expense, and depreciation on the store equipment, which is used to sell the inventory because that's in the store. So that would be a selling expense as well. Therefore, our selling expenses are our biggest line item for expenses. And we have to record those first. So we have our sales salary expense, our advertising expense of $45,000. Our depreciation on store equipment. And then our miscellaneous selling expenses. And miscellaneous or other expenses will always go at the bottom. Now it's asking us for a subtotal, and you can see our next expense, office salaries, rent expense. These are administrative expenses. That's something like for the head office. That's not for the people actually doing the sales, like the sales associates, like the um, advertising. So we need to add up our total sales expenses, total selling expenses, and they come to a total of $372,000. Next comes our administrative expenses, starting with office salaries expense. This is our biggest administrative expense at $175,000. Then we have our rent, $28,000. Insurance of $3,000. Office supplies expense of $2,000. Depreciation expense office equipment of $1,500. And miscellaneous admin expenses of 3,000 or $3,500. We're going to add up our total administrative expenses. And we need our label for total administrative expenses. And the total of all of these administrative expenses comes to $213,000. $213,000. Uh, and that's the end of our operating expenses. These rent revenue and interest revenue, it's considered non-core to the operations of the business, so we don't want to include it in operating expenses and operating revenues. Our operating expenses are simply due to creating the selling and administration of the merchandising business that we have. The rent, the interest, that's ancillary, that's non-core to the business, and so we're including it as non-operating income. So the total operating expenses are $585,000, and that we'd get that from adding up our selling and our administrative expenses. We get 585,000. We subtract our operating expenses from our gross profit. We get a operating income, or income from operations is what's in our account, our labels. We get $180,000. Now we're going to go through our other revenue. And our other revenue and expense. First one being rent revenue of $7,000 and interest expense of $2,000. And because it doesn't give, this is our bottom line of the income statement, this has to be net income at the bottom. However, we still have this line here. This is where we can take 7,000 minus 2,000, then we get our net other revenue and expenses. So our net income is $185,000. If we check our work, that's full credit on the income statement portion. Perfect. Now it's time for us to do our closing entries. We do have a drawing account. So we're going to have our net income closing entry and our drawing closing entry. Also, under the periodic inventory system, our cost of goods sold accounts purchases, purchase returns and allowances, discounts, freight in. Instead of closing out cost of goods sold as our cost of goods sold expense to net income, these purchases, purchase returns and allowances, purchase discounts, freight in, these amounts we're going to have to close out on our own what the adjusting entry needed for it is. Also, because we're not adjusting our inventory, we don't have our ending inventory on the balances here. That's because ending inventory gets adjusted as part of the closing entries when we close out these purchases, because purchases, closing it out, this is related to cost of goods sold, but it's also related to the inventory that we need to have at the end of the year. So for our closing entry, it's going to be as of December 31st, and we're not going to need post references for any of these amounts. We're going to fill in our debits from the top, and our credits we're going to fill in from the bottom. However, at the bottom, we will have our simple entry to close out our drawings. Our drawing amount was $25,000, and we need to credit our drawings account, and we need to debit the capital account for the same amount. Accounts that we're going to have to close out as debits. What on here? So sales is a natural credit balance, and we need to zero this out. And we'll just make this easier to look at here. Our sales, we have to debit for $3,280,000. Our rent revenue is a debit, $7,000. And our interest expense is a credit for $2,000 to reduce our debit. We're also going to have to reduce all of these other expenses. Miscellaneous administrative expense, depreciation expense, office supplies expense, insurance expense, rent expense, office salaries expense, selling expense, and depreciation of the store equipment. We'll start going and filling in these amounts. Our insurance expense is $3,000. Rent expense, $28,000. Office salary is $175,000. Miscellaneous selling expense for $12,000. Depreciation expense on store equipment, $6,000. Delivery expense, $9,000. Advertising, $45,000. And sales salaries for $300,000. Now all that's left is to do our entries unique to the periodic inventory system. And this is to close out all of our purchases, purchase returns and allowance, discounts, freight in. Because beginning inventory shows up on the income statement, it's used to calculate our cost of goods sold. So in order to calculate it for our debits and our credits here, for illustration purposes, we're going to include a debit and a credit to inventory, as opposed to debiting or crediting the net change in inventory. We're going to credit our beginning inventory, our beginning inventory was $257,000, and we're going to credit this. This zeroes it out. And that's like zeroing out our expenses because our beginning inventory was sold. Then we're going to debit our ending inventory. So this has the effect of zeroing out and then increasing to the amount that is our ending inventory. In the instructions, our ending inventory was $305,000. So that's going to be our debit. We also need to debit our estimated returns inventory. And this is because our estimated returns inventory increased by $5,000 this year. So we need to debit it because that increases our balance. You could also record this individually, but we don't have the lines on the journal to do that. By debiting and crediting the ending balance. If we did, we would have a credit of 35,000, a debit of 40,000, and our net change would be $5,000. However, because this is an adjustment and it's not included on the income statement here, we had the beginning balance of 257,000, the ending balance of 305, and we only included the change in estimated returns inventory. So we're also only going to display it like that here on the journal as well. Now we have 4 accounts remaining, and we have our 4 main balances here. Our purchases need to be credited because purchases increase inventory or cost of goods sold. In this case, cost of goods sold because our ending inventory is fixed for the purposes of the periodic inventory system, or so it needs to be a credit because it's a debit balance. Freight in also is a debit balance because it increases cost of goods sold. Purchase returns and allowances reduce cost of goods sold, so they need to be credited, as well as purchase discounts. Our final entry is going to be our net income, which is also the net change. However, we're going to call it the cap, where we have to debit it to the capital account, of course. But the net income of $185,000 is our amount. That is the difference in our debits and our credits, and also that's the amount that needs to be closed out to the capital account. And that's it. We got 100% for this portion of the homework for all of our closing entries. On to the final question. What will be the net income if the perpetual inventory system had been used? It's going to be exactly the same. The inventory system used to record and do the calculation has no impact on what the cost of goods sold actually is. The ending inventory is the same either way. and which means the cost and the amount paid for the inventory is the same. The cost of goods sold is going to be the same. Gross profit, same. Net income, same. Even though the accounts vary, the financial statements amounts are the same, even if the presentation method is different. Thank you all for watching. I wish you guys luck on completing the homework for this week.